This is John Sadler, and I'm president of Sadler Contractor Insurance, and I designed this video to help educate and provide useful information to both new and veteran builders. I'm going to talk about all aspects of builder's risk insurance, including which policy form is best for you, as well as coverage pitfalls to avoid and money-saving tips. Builder's risk insurance is really a misnomer. It has nothing to do with liability insurance or getting sued. Instead, it's simply property insurance on a construction start. In some parts of the country, it's also referred to as course of construction insurance. Builder's risk covers perils such as fire, wind, theft, and vandalism, and many more. It typically does not cover perils such as earthquake, flood, or wind in beach zones unless the policy has been specifically endorsed to do so. If you're going to properly set up your policy, coverage should be effective prior to when the materials are delivered to the job site. Coverage ends upon the earlier of closing the sale, occupancy, or the policy expiration date. After builder's risk coverage expires due to sale or occupancy, the new owner should take out permanent property insurance on the building, such as a homeowner's policy or a commercial property policy. I'm frequently asked if it's okay for a custom builder to allow the owner to take out the builder's risk policy. Based on my experience, this is a very risky proposition because I've seen problems arise when the contractor loses control of the transaction. First, the owner may fail to procure coverage even if the building contract requires him to do so. Second, the owner may purchase an inferior policy with unacceptable coverage problems that we'll discuss in a minute. I strongly recommend that the builder should always take out the builder's risk policy to make sure that these common problems don't arise. The builder could lose tens or hundreds of thousands of dollars and be put out of business if the owner makes a mistake and if a claim is not covered as a result. Here's a list of the most common builder's risk coverage problems that we see when we analyze policy forms that are offered by our competitors. These problems are typically found on policy forms used by insurance carriers that specialize in writing personal insurance. In other words, the ones that advertise most frequently on TV. The first is an exclusion for the theft of building materials before they're permanently attached to the building structure. If your policy has this exclusion, it could be an expensive mistake if a heating and air unit or other expensive appliances or materials are stolen shortly after delivery. The second common policy exclusion is collapse of the building structure. Several years ago, one of our builder clients had a collapse to the tune of about $30,000 when the unbraced framing of a house blew down during a severe thunderstorm. It would have been bad news had he had the collapse exclusion. The final common problem is when the policy form does not allow the builder to ensure reasonable profit. If you don't have coverage for profit, you'll end up having to build the structure 2 times but only get paid for your profit once. That doesn't make sense because the purpose of insurance is to make you whole after suffering a loss. I strongly recommend that you should always buy your policy from an insurance carrier that allows you to insure profit, and profit should be built into your estimated completed value for your start. Here are the 3 most popular ways to insure your builder's risk exposure, ranging from the most expensive to least expensive and the most time-consuming to least time-consuming to administer. A single shop policy means that each start has its own separate builder's risk policy with a policy term of 1 year. A single shop policy is best for builders with 5 or less starts a year, remodelers, and commercial contractors. The advantage of the single shot is that there are no volume commitments in terms of the number of starts that you must have to qualify with the insurance company. The disadvantages of the single shot are that there is no premium returned if you sell the start before the end of your 1-year policy term, and it involves the greatest amount of administrative hassle. In other words, every time you have a new start, you must play communication tag with your agent to get a quote and bind coverage. Builders with 6 or more starts in a year can save money and reduce their administrative hassle time if they use the monthly reporting form or annual audit form. The monthly reporting form used to be our most popular builder's risk form for builders with 6 or more starts. The builder completes the reporting form on a monthly basis and reports the prior month's new starts, including their estimated completed values. Once reported, a start is covered for 1 year. The builder also re-reports any starts that are greater than 1 year old and still not sold. These old starts must be renewed for an additional annual term. The builder computes the premium that's due by multiplying the rate that's listed on the form times the estimated total completed values for all new starts and re-reports. The builder then mails the completed monthly form and check back to the insurance company. The first advantage is that the rates are slightly lower than the single shot, and the second advantage is that self-reporting reduces the administrative hassle of playing communication tag with your agent on every start. The disadvantages are that our builder clients sometimes forget to send in their monthly report, or they forget to re-report the starts on the unsold dwellings that are over 1 year old. Failure of the insurance carrier to receive the form or failure to re-report an unsold dwelling can result in no coverage on a start. We've had several instances where our clients have had a claim denied for one of these reasons. This is the reason why we now recommend that most of our clients use the annual audit form instead of the monthly reporting form. If you're going to use a monthly reporting form, make sure that you have a foolproof suspense system and don't rely solely on your monthly reminder letter from the carrier to send in your monthly report. The annual audit is the preferred form for covering builders with 6 or more starts. It's taken the place of the monthly reporting form as the most popular way to insure larger builders within our agency. The policy setup premium is based on the projected 12-month number of new starts multiplied by their average estimated completed value, plus the completed value of homes in existing inventory for greater than 12 months. Multiply the total values times the rate to determine the policy setup premium. A payment plan is offered to spread the cost over 9 months. After the end of the policy year, your actual number of starts and values are audited and the final cost of the policy is determined. If the audit premium is greater than the policy setup premium, you owe additional premium upon audit. On the other hand, if the audit premium is less than the policy setup premium, you get a refund upon audit. The main advantage is that there are no concerns about forgetting to send in a monthly report and the resulting lack of coverage on a start. In addition, the rates are discounted as compared to the single-shot policy. Determining the proper insured value or limit of coverage is critical in both protecting yourself and in not overpaying. Most builders' risk policies require the policy limit to be set at the estimated completed value. Completed value includes not only labor and materials, but also overhead and reasonable profit. One of the biggest money-saving tips is that non-repeatable expenses should be excluded from the estimated completed value, including land cost, real estate commissions, landscaping, impact fees, and architect fees. This one tip alone could save hundreds of dollars of premium every year. I very much appreciate your time today and hope that you'll contact us for your builder's risk needs.